there's still a lot of confusion over Geithner's new plan and the legacy loans and the legacy securities program and how much leverage does it allow and what are all of the different ways to game the system. And to be frank, the more I read about it, the worse it begins to look. And everything that I've talked about in the previous videos about how you could game it and the amount of leverage and the insurance that the government is giving away for free is actually worse than I originally thought. So just to clarify things, so if we could call it the public, what is it called? The public-private investment, fund or program or whatever it's called. I call it the Geithner plan. There's actually two different plans here. There's the legacy loans plan, legacy loans, and then there's the legacy securities plan, legacy securities. Everything I've talked about so far has been the legacy loan plan. And actually that's my bad, because it's really the legacy securities plan that's a lot shadier. And just to be clear, legacy loan plan is if there's some bank over here, it's got on its books, let's say it has some actual loans. These could be construction loans or loans for commercial housing, whatever. It's just a group of loans out there that it needs to get off of its balance sheet. That's what the legacy loans program allows to do. Some private investor can contribute $7. The Treasury will contribute another $7. The Fed will give a $86 loan, and then they can use all of that money. And actually, I should have done it on the other side of the balance sheet. But this will be, let's say, $100 of buying power that they can go use to buy these loans off these banks. And that's fine. And, everything I talked about before, the put option and all of that, that still applies here. You're still getting, depending on how you view it, either 6-to-1 leverage or 12-to-1 leverage, depending on, how you want to think about it. But everything in the last videos apply. But what's kind of shady here is, this is the program that they're opening up to everyone, or anyone who can kind of navigate all the paperwork and how you can get included, et cetera, et cetera. But essentially, a bunch of hedge funds and investment funds can participate in this, and because there will be so many participants, it'll be probably pretty transparent. But what's weird about that is that legacy loans, although that is part of the problem with all of the illiquidity that's happening, that isn't kind of the crux of the problem. The crux of the problem were all of these mortgage-backed securities and collateralized debt obligations and all of that, and those don't apply in the legacy loan program. So the thing that you're applying to everyone isn't the thing that's really the big problem on sitting on banks' balance sheets. Most of the toxic assets that everyone talks about, so most of the things that, when let's see, this is another bank's balance sheet. This is its liability. This is its equity. Most of the toxic stuff that people are talking about, let's say this is a toxic asset. These aren't legacy loans. These are CDOs or derivative CDOs or mortgage-backed securities, whatever you want to view it. And these fall under the legacy security program. And these are the things when everyone talks about the market's only willing to pay 30 cents on the dollar while the bank's only willing to sell it for 60 cents on the dollar. That applies to this reality here. And when you look at the legacy security program, it is a lot shadier than the legacy loan program. This one is open to anyone, or for the most part anyone. This program right here, it's only going to be open to 5 investment managers. 5 managers. And it's not like, there's 500 people could compete to be those 5 managers. They've actually set the bar pretty high on who can be a manager. You have to have 10 billion under management, and not total assets under management. 10 billion of this kind of stuff already under management. So you have to have $10 billion already under management of collateralized debt obligations and mortgage-backed securities. And then maybe out of all of these, the less strict thing is that you have to show the ability to raise $500 more million to participate in this plan. So even though they say that you have to apply to be one of these 5 managers, there probably aren't more than 5 managers already out there who have 10 billion under management of these types of securities. I mean, if you have 10 billion of these types of securities, you probably have hundreds of billions under management. And frankly, 2 names come to my mind immediately. I haven't done enough research on this to figure out who the other 3 are, but PIMCO and BlackRock are definitely going to be included in that group. and then there's going to be 3 other people. So even though the Geithner is making it look like it's some type of competitive process, he's essentially already picked the people, and I'm sure he's already had conversations with the 5 guys who are going to participate in this, because he wouldn't have projected out this number 5 unless he already had the agreement of these 2 guys and then 3 more. And then what makes this even shadier, obviously this is going to be more closed and more opaque to the outside world and what's going on. You could easily get 5 guys in a room and kind of make a deal. What makes it even shadier is that the leverage allowed in this program is even more extreme than the leverage allowed in this program. So here, just to give you, let's say I had Pimrock, and that's the mythical firm that everyone is talking about now. What you could do now is, instead of putting $7 of equity, you could actually put in $350 of equity. $350 of equity. The Treasury is going to put in another $350 of equity. The Treasury is going to put in another $350 of equity. So far it looks a lot like everything I've described so far. So this is from the Treasury. And this program allows a further 100% of the equity base loan from the Treasury. So then the Treasury will give, let me do loans in yellow. So the Treasury is willing to give another $7 loan to this fund that we're creating. And now we have, once again, $14. And then this fund can then participate in the Legacy TALF program. And the Legacy TALF program involves the Fed essentially, giving you this 6-to-1 ratio. And actually, it's up to their discretion. So a lot of this is going to be opaque to, us bystanders. But, I have a sense that they're probably willing to give even more leverage. But let's say that's the same leverage that everything we talked about in that plan. So you're essentially going to have another $86 loan from the Fed, and I know it's getting messy. $86 loan. And now this manager, Pimrock, who only contributed $350, will control $100 of buying power. So this becomes 30-to-1 leverage. 30-to-1 leverage, where the loan isn't just from the Fed anymore. Right? This is the Fed loan, $86. But there's also a fairly large loan coming from the Treasury. And, we all know, and a lot of people have emailed me and said, hey, what happens when these loans go bad and the Fed takes a hit, the FDIC becomes insolvent? Well, I think the FDIC knows the answer to that question. It's anything issued by our dollar bills we have, those are Federal Reserve notes. They're issued by the Federal Reserve, but they're backed by the Treasury. So what essentially is the Federal Reserve is a government-sponsored entity, just like Fannie Mae or Freddie Mac, and essentially says if the Federal Reserve or the FDIC ever goes bankrupt, the Treasury will take the hit. So really, even though this is a loan from the FDIC or from the Federal Reserve, it's being backed by the Treasury. So all of this is a loan from the American people, right here, essentially. I wanted to make, and so this actually hugely changes the economics of kind of the put option relative to the video that I made here on the put option. An investor here, this is an equivalent put option, just so you get a sense of it. If you were going to pay $30 for something, in my previous video I said, well, instead you could put, this is non-Geithner. This is the non-Geithner reality. Now, in this reality, if you are one of the select 5 individuals who are allowed to participate in this program, what you could do is you could put in $250. Now, let me make sure I get the numbers right. No. You could put in $225. Let me draw it out. You could put $225 of equity. The Treasury will put in $225 of equity. So that's what, $450. Then the Treasury will give you another $450 loan. $450 loan. So we have about $9. What is that? That's $450. Yeah, we have $9. And then the Fed will give you a $51 loan. Let me do that in a magenta. So then the Fed will give you a $51 loan. And now you have $60 of buying power. $60 of buying power, which you could use to buy 2 of the securities you would have bought in the non-Geithner scenario. And the reason why I say you want to buy 2 scenarios is because I want to show you that because you have to split the equity, right? This goes to the Treasury. This goes to PIMROC, right? So since you have to split the equity, you actually want twice as large of a position to get the same upside, right? So this is a reality where PIMROC has only put 225 of risk of capital at risk, but they're going to get the same upside as they would have gotten in the non-Geithner scenario, putting $30 at risk, right? And you could work out the math. If this thing ends up being worth $40, then this thing ends up being, because you could have bought two securities with this, two $30 securities. Two $30 securities. So then this thing will become worth $80. And then each of these, so that $20 of profit, right? You had $60 before of assets, now they're worth $80. That $20 of profit would be split between PIMROC and the Treasury, so $10 of profit each. So in either case, you would benefit $10, but obviously in the downside scenario, these guys take most of the hit. But let's very quickly value that option, right? Because you could have either put just $30 of your capital at risk to invest in the security, or in this scenario, you could put $225 into the fund, and then you could have put, $27.75 in cash or treasuries, or essentially money that's not at risk. And the payoff diagram here will look something like this. That no matter what the price of the security, let's say that this axis is the price of the security. That's the price of the security, and then this is the value of your investment. So in this reality, it's just a line with slope 1, where let me draw that out. Where if your investment is 30, if the price of the security ends up being worth 30, your investment is at 30. If the price of your security ends up being 60, the value of your investment is 60. That's in the non-Geithner scenario. In the Geithner scenario, you make all of this money if your asset pays off. But if your asset price drops below $27.75, right there, you're made whole because you put $27.75 in cash. So the payoff diagram for the TALF's legacy loans or legacy security program looks something like this. And this is essentially you owning the security plus a put option. Right? And just to value that put option, let's see. So if we say the stock price, the security price is 30, these aren't stocks, but these are securities. The strike price on your option, it's a put option at $27.75. You have the right to sell this security at $27.75. Interest rate, we can make it something pretty low because we're not going to borrow. The dividend yield is pretty high on these things because they're yielding a lot. And then the volatility, we could say it's pretty high. And then the time to expiration, we could also say it's pretty high because these are going to be 10-year options, essentially 10-year American options, because you can exercise them at any point. And when I hit calculate, I get the value of the option, and these are actually American put options, so $21.50 approximately. So for $30 security, for what was a $30 security, the government between the Treasury and the Fed is giving an approximately a $22 free put option. Free put option. And so they're essentially giving you an incentive to pay as much as, well over 90% above the true value that you would have otherwise been willing to pay for the security. You'd be willing to pay, you'd be neutral. If you were neutral at 30, now you'd be willing to be neutral at $50 or $52 for each of these units of security. So this changes the economics dramatically. This by itself might actually close the bid-ask gap, but obviously most of that is coming from a subsidy from the government. In the next video, I'll show you kind of how this is actually a huge incentive also to game it, because these PIMROC guys, these 5 fund managers, they also have a huge interest in participating in this plan, even if they thought that this was a bad investment, because they can make so much money on the rest of their portfolio. And I'll do that in the next video. See you soon.